Give us your point of view from private equity right now. You've got valuations high in most areas around the world. You've got global growth slowing around the world. Money's pretty cheap. As you look at that world, where are the opportunities? Where is there underpricing? Where are there bargains?
Well, we wouldn't put you out in our fundraising team if you were going to have that kind of presentation. We do think that there's still good opportunities. Remember, the rates of return of private equity firms used to be in the 20% net internal rate of return area. Today, I'd say 15% net is probably closer to what you can really achieve on an average, and that's still pretty attractive to investors. The U.S. is still by far the best place in the world to invest. The rule of law, transparency, quality of the managers, quality of the exit opportunities. So there's plenty of good opportunities here. You just have to have lower expectations for rates of return. I'd say outside the United States, Europe is still relatively cheap. Prices are lower for comparable assets, so that's still pretty attractive, and it's a developed market. In the emerging markets, so-called, China is still in a league by itself because of the size of the market and the welcoming of private equity. Private equity does not scare the Chinese regulators, so China is still very attractive in our view.
So when you take a look at, say, the decline in global bond yields, does that, A, make it harder to make investments because there's going to be a lot more competition for capital and for assets that are going to actually yield something?
There is more competition than there used to be. For example, take in China. We used to have the private equity world almost to ourselves, the American firms that came in and bought things because we had expertise. Now they're indigenous Chinese firms that are very, very good. So there's more competition there. There's competition everywhere. It's harder for the Chinese companies to buy things here for a lot of regulatory reasons. That probably won't change for some time. That's why the Chinese companies are often now buying things in the emerging markets or in Europe because it's easier for them to do so than in the United States.
Do you have to take into account geopolitical risk, and particularly trade risk, to a larger degree as you make acquisitions? For example, is it more attractive to have a business that's strong in a domestic market as opposed to one that's really heavily dependent on international trade?
Almost any company today is really dependent on some international trade. There are very few companies that are just completely indigenous to, let's say, the United States or China, because any big company is really doing business all over the world, manufacturing it or selling things all over the world. Clearly, these are factors, but when we're making longer-term investments, 5- and 10-year investments, you can't worry about the daily vicissitudes of the trading markets or politics. You have to take a longer-term perspective, and that's what most of us do.
Vicissitudes. I like it. Good one. So when you sort of outline regions that have value, what about sectors and areas? Because if you talk China, and you're thinking 5-10 years out, I'm thinking consumer. What do you
let me make one area that I think is very attractive. It's healthcare. The baby boomers are aging. 10,000 baby boomers are turning 65 every single day in the United States. And the baby boomers have the most wealth. So they will spare no expense on their artificial hips, their artificial knees, their transplants, whatever they need. And so you're going to see a lot more money go into healthcare because these baby boomers want to stay alive and be reasonably healthy. So in this country and in other countries, you're going to see a lot more in healthcare. For example, in China, as people are living longer, or in Japan, or in Europe, as people live longer, they want to spend their money to keep reasonably fit. And so you see a lot more money going to healthcare, all kinds of healthcare, and that's a very great growth sector for us and other people like us.
So I want to give you an opportunity to respond to your good friend Warren Buffett, because out at his annual shareholder meeting, he had a few things to say about private equity, not all of which were attractive. Among the things he said, we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that I would regard as honest. It's not as good as it looks. Now, I'm not talking about Carlyle now, but does he have a point actually about private equity in general? Because they are not subject to necessarily the same sort of regulation, and maybe we don't have the same transparency, particularly in the way they account for their funds.
So Warren Buffett's the greatest investor of our lifetime. I'm not in the business of contradicting Warren Buffett. Let me just say that sometimes people in the private equity world do like to talk about their gross internal rates of return, pre-fees, and other kinds of considerations like that. The net internal rate of return is probably more relevant, and that's what we like to talk about, what the net internal rate of return is. But the net internal rate of return of private equity over the last 5, 10, 15, 20 years has outperformed any other asset class around the world. And so it's still pretty attractive, I think. And that's why people are giving a lot of money to firms like ours.
Do you think that that will continue, that kind of rate of return over the next 5-10 years?
Well, if there is any virtue in this world and God is looking down favorably upon us, I think it will, because we're doing a very good thing, I think, for investors. We're doing a pretty good job of making companies more efficient. We're helping the economy, in my view, in doing that. So I think we have the skill set to kind of make good returns for our investors still. But there's no guarantee in life. So if you want to invest in our funds, we can't guarantee anything, but we have a pretty good track record. Firms like ours have a pretty good track record.
How much are you invested in right now, and how much dry powder do you have, and kind of what are you waiting for?
Well, the entire industry has more than $1 trillion of dry powder, but it's not like you go to jail if you don't invest the money. We're not investing the money if we don't have good deals. We have to get very good deals to make this work. And if we don't use the money, we don't invest it, it goes back to the investors. It's not like it's burning a hole in our pocket.